So next up, we have a presentation from Queensland Pacific Metals with the ticker code QPM. QPM's wholly owned subsidiary, QPM Energy, is the 100% owner of the Moranbah gas project, which is located in the Northern Bowen Basin. To tell you more, I'll introduce you to David. Good morning, David.
Yep. Hi. Yeah. Hi, Jane. How are you?
Very well, thank you.
Good. Thanks, Jane. Thanks for the opportunity to just spend a little bit of time talking about Queensland Pacific Metals and QPM Energy. The company has been through a bit of a transition over the last 12 months, and essentially the company is now focused on operating and developing a very significant onshore, as opposed to Mario's place, onshore Australian gas asset in Queensland. It's centred around an asset called the Moranbah Gas Project, which is a place called Moranbah, which is about 200 kilometres west of Mackay in central Queensland, and it's an existing operating gas supply and electricity generation business. It's an asset that's been running for about 20 years. It's still got very significant upside, both for development of increased gas supply and increased reserves. So it's been going 20 years, and it's got at least another 20 plus years of upside with the asset itself. We acquired the asset back in August 2023, so just over a year ago, and it was originally intended, and the strategy behind it was to secure a gas supply for the company's other asset, which is the Teck nickel refinery project in Townsville. I guess, as everyone would be aware on this call, the nickel market conditions have deteriorated significantly over the last 6 or so months, and hence our pivot as a company to focus on our energy asset, which is an up and running and up and going and operating business. We still, however, have the Teck project in play. Effectively, what we're doing with the project is continuing to develop it and progress towards a commercialisation step. And to that end, we've been assisted through about $16 million of government funding, half of that from the federal government, half of that from the state. And that puts us in a really strong position to continue to develop the project. Our team on that project is fully funded, and it allows us to work towards an opportunity to maximise value for QPM shareholders. People may be aware that over the last few years, we have entered into offtake arrangements and equity subscription agreements with General Motors, LG, and POSCO. So it's a pretty solid project. And is really well positioned to participate in any recovery in the nickel market, which we all know will happen over time. Turning to the energy business, QPM Energy, and as I mentioned earlier, it is an integrated energy business. So we produce gas, we process and compress it, we supply gas to customers, and also we run a power generation asset, a large power generation asset in Townsville. We have 4 petroleum leases in the Moranbah area, about 500 square kilometres. We're currently producing around 30 terajoules a day, or 11 petajoules a year, and that's trending up. It's quite a large gas field, about 125, approaching 130 producing wells. Big reserve position, particularly in the context of Eastern Australia. We have about 330 petajoules of 2P reserves, all of that within our production petroleum leases. And of that, over 200 petajoules is currently uncontracted. The asset has an extensive gas gathering, processing, and compression infrastructure footprint, lots of which has been developed over time. And it's a strong revenue generating asset, where we generated $75 million of revenue in the financial year just passed through to June 30, 2024, and 50 million of that was in the second half of the financial year. We announced last week that 2 key contracts that underpin the business have been renegotiated successfully, which will provide a substantial improvement in our financial viability. The This is a little bit more of a detailed map of the project location. So Moranbah is really the centre of the Northern Bowen Basin coal mining region, and these are the premier steelmaking coal assets. BHP, Anglo. Obviously there's been very interesting acquisitions by Stanmore and so on. So this is a very, very prolific coal basin, and the same geological conditions that created the high quality steelmaking coal have created a phenomenally large gas resource, which is hosted within the coals. Our project, located there just north of the town of Moranbah, in and around the Grosvenor and Moranbah North and Isaac Plains mines, is producing gas from the main coal seams that are being mined by the mining companies. We also have relationships with a number of the regional mining companies where we take gas that they're producing as a byproduct of their mining operations, and we manage that for them. It allows them to continue mining safely, but also manages their CO2 emissions. Extensive infrastructure footprint, big compression facility. That's our main compression facility that injects gas into the North Queensland gas pipeline. That's the only compression facility that gets into the pipeline. We have the capacity rights on that pipeline from Moranbah to Townsville. Has extensive storage capability. It's like a big battery. Effectively, we store gas in it and then run the power station at the other end of it during peak electricity price times. And we have all the rights to dispatch the Townsville Power Station, which is a 242 megawatt gas-fired power station. So it's a fully integrated business. We acquired as I mentioned, we acquired the asset a year ago, and it had been, as I said, been developed originally by a company called CH4 back in 2004. And this chart here shows the production trend, overall field production trend since that time. And in its heyday as a production asset, it was running at around about 40 to 50 terajoules a day. And since 2010-11, has seen a sort of a steady decline in production. However, what we've found, and since we took over it, control of the asset in August 2023, right at the right-hand side of the chart there, the decline in production hasn't really been around the decline in field production or well production. It's actually been linked to the decline in the number of producing wells. And what we've done since acquiring the asset is that we have worked really hard to bring a large number of wells back online and back into production. And what that's done is it's basically reversed the field decline, and quite significantly. So we've actually found that the field is not a declining field, it's a mature field, but with a very stable production profile. And the more that we can operate efficiently and effectively and continue to keep wells online and producing, the more production we get. So very, very cost effective for us. These wells are quite old and very stable in their production profiles. So we're finding that we've got a really, really good asset here that underpins the company. Since we took over control and operation of the asset, we've done a heap effectively. We've increased producing well count, as I just mentioned. We're up around 130 wells as of today. Our gas supply's up largely as a result of that. Reserves are up. We've been able to recalibrate the understanding of the field reservoirs, and I think and certainly this led to a substantial increase in independently certified reserves, and we suspect there is more to come there as we learn more about the field, and in particular as we get results coming through from a new well drilling campaign that we're currently undertaking. And we're well advanced in that program, so we are now complete, about 70 or 80% complete for that program. So we should see production from those wells really starting to meaningfully contribute towards Q1 next year. We have a strong relationship with our major customer. Our major customer is Dyno Nobel, or Incitec Pivot's subsidiary Dyno Nobel, who have a large ammonium nitrate manufacturing facility in Moranbah. They manufacture They use our gas to manufacture explosives for most of the major mining operations in this part of the Bowen Basin. And as part of our relationship, Dyno Nobel have provided a development funding facility, an $80 million development funding facility, which is targeted to increase production and reserves across the field. And this drilling campaign that I've just mentioned is fully funded by that facility. We have last week announced we've agreed new commercial terms for the access to the North Queensland gas pipeline and the Townsville power station, and they have been at substantially more favourable terms than the legacy contracts which we inherited when we bought the assets. Been a few challenges. We've had a whole bunch of field-related activity going on. We've been really busy, but we've had fires both above ground and underground. We've had floods, and we've had a lot of, like most remote sites, a lot of illness through tail end of COVID and so on. We have had a major incident. We experienced a major incident at the Grosvenor coal mine, Anglo's Grosvenor coal mine, where there was a major underground gas ignition. And that's in an area which is in the middle of our field, and that has caused us some operating problems. We're largely through that now, but what it does show is that there is still a huge amount of gas left in these coals, even in an area where this incident happened, which had been we had been producing gas from for almost 20 years. So it really underpins. I mean, it's an absolute disaster for the Grosvenor mine. But from our perspective, it actually shows the incredible reservoir and reserve capacity in this field, and the upside around producing gas, continuing to produce gas, even from areas that have thought to be fairly depleted. I might just spend a little bit of time talking through our agreements or the terms we've agreed with the North Queensland gas pipeline and the power station. Those contracts. We had legacy contracts that we inherited when we bought the asset, and they were the original contracts that underpinned the development of the whole project back in 2004. They were set up effectively to allow the Townsville power station to run in a baseload capacity, so using about 27 or 28 petajoules of gas a year. And they included very high fixed charges for the capacity on the pipeline and the power station, and of course they were all CPI escalated. So by the time we get to the end of those contracts, which is exactly where we are now, it's incredibly high impost on the business. Of course, it's not economic to run the power station now as a baseload station, given the way that the electricity market has changed over the last 20 years. And so, but the power station itself is perfectly set up to run as a peaking power station to support the electricity market's transition to a more renewable generation base. So that's the way we're now using the power station, and the new agreements for both the pipeline and the power station have been reconfigured to absolutely suit that operating those operating parameters. So it massively reduces our annual fixed cost burden going forward, and in fact, what we've been able to do is reduce fixed commitments and replace them with, by and large, largely variable cost commitments, which are linked predominantly to the amount of electricity revenue we generate from the power station. So it suits our business model very, very well. Just out of interest, the impact of those changes to contract terms would have improved our FY 24 financial performance by about $30 million. So you can kind of see the significant improvement that this business is set up to achieve in a cost out basis in coming years. It really does underpins the business now with a pretty financially robust platform, so we can really focus on driving both production and gas supply growth. As I mentioned, we have a large uncontracted reserve position, and that's what we're now focused on. We're looking at increasing our gas-fired power generation capacity both in Moranbah and in Townsville. We're also looking at starting to establish smaller scale micro LNG facilities to allow gas to be delivered to more local industrial users of gas, both in the Moranbah-Mackay area, of which there are a number of energy users burning diesel, and similarly in the Townsville area. North Queensland has been, industry in North Queensland has been impaired for a long, long time by lack of cost-effective gas supply. So we believe there's quite a significant opportunity to grow, a meaningful gas business in those two areas. Clearly, this asset is extremely well positioned to play a part in the larger Eastern Australian gas market shortage. We are a big asset by any stretch and getting bigger in terms of reserves. And at some point, my expectation is that it will be feasible and very commercially feasible to develop a piece of infrastructure that runs from Moranbah into and connects into the Eastern States gas infrastructure network. That's about a 380 to 400 kilometre pipeline. We have all the compression ready to go. It's a pretty interesting opportunity, and I suspect we'll work towards that over the coming period. In the near term, what are we doing? It's a continued focus around gas production and supply. Our target is to hit around 35 terajoules a day from a combination of our existing field capacity and the new wells we're drilling. We're deepening and developing our linkages with local coal mine operators, and in particular working with them as a service provider to help manage their fugitive gas and waste coal mine gas emissions, which is becoming a very, very important part of their businesses. We're looking to move on a number of opportunities within the Moranbah area for increased power generation, and some of that will come out in the next few weeks. More opportunities around smaller scale delivery of gas to customers in and around Moranbah and potentially Townsville, and really focus on growing reserve and resource base. So, in summary, we're a pretty cheap company. We're pretty attractively valued when compared to our other ASX listed, Eastern Australian gas players. Big reserve position, most of which is uncontracted. It's very important to note that sits all within granted petroleum leases, all with granted environmental approvals. We are able to operate our business. We don't need any more approvals. We're drilling wells right now. We are able to prosecute and develop our activities without having any approval holdups. We've got production from both our own managed production, and we source in increasing volumes of gas from third parties, and that's predominantly coal mines. We're drilling wells. We're funded for those development activities. We are well positioned, and we're one of the very few players, independent merchant players, in terms of providing firming electricity generation into the national electricity market. Everyone's aware of all the talk around Eastern States gas markets, but again, we're right there. We are operating a power station. We are, working with coal miners and some of the largest carbon emitters in the Bowen Basin, who are now being driven to manage their emissions through the safeguard mechanism. And that's a government policy which requires them to reduce their emissions by about 4.9% a year. And clearly, their emissions are driven by methane, which they produce during their coal mining process. We are unique in that we're able to manage and help manage those emissions for them and actually add value to their business as well as our business. So that's a QPM, a very brief snapshot, and happy to take any questions.
David, that's wonderful. Thank you for that. I'll just get you to stop sharing your screen and I'll jump into them. So the company has stated that it plans to increase production. So outside of drilling new wells, what other initiatives are expected to drive this growth?
We've got three areas that we're working on to increase growth. First of those is drilling wells. That's the key. Second of those is continuing to increase the number of existing wells that we have in production. And the third area is that what we've found is that as we reduce gas pressures in our gathering network. So we reduce pressure across the field. We're getting more production from those older wells. And that's a big focus for us over the next 12 months to continue to do that. And we've already seen some very interesting developments there. So we're one of the, it's a very mature field. And what we've found is that production growth comes from lowering pressure in the system, and that's a big focus for us. So pretty simple stuff, but we've got a number of 3 different ways or 3 different initiatives underway to grow production.
Thank you. And a question I've been asking everyone today. So what value accretive catalyst should we be looking out for over the coming quarter and into the end of the year?
Yeah, so for us, the steps are some concrete announcements around what we're doing with power generation, and we're working on those, and they're imminent. It's around how the new wells that we've drilled start to perform and into the back end of this year. And then the final area would be for us around reserves and reserve growth. So those are 3 key drivers for our business, and we've got really exciting activities underway in all of those areas that will be announceable and a catalyst, we think, for a substantial re-rating in the stock over the next 3 months.
Well, David, thank you for the great presentation. And if we've missed any of your questions, please feel free to reach out via the contact details, which can be found at the bottom of the ASX releases. But thanks again for your time.
Thanks, Jane. Cheers. Bye-bye.